Stop what you're doing for a second. Whether you're a college student about to get your first car, a parent replacing the family SUV, or a professional who thinks they've already figured out how car financing works, this video is going to reframe something you thought you understood. Here is what the Federal Reserve Bank of New York just confirmed. Americans are now carrying $1.69 trillion in auto loan debt. That number is so large it has just surpassed total student loan debt outstanding in this country. And before you write that off as an abstract macroeconomic statistic, consider this. The share of borrowers who are 90 days or more behind on their car payments has now almost matched the peak it hit during the recovery from the 2008 financial crisis. Back then, unemployment was above 9%. Today, it's 4.3%. The economy, by most measures, looks fine. And yet the car loan distress signal is flashing the same red. This video is going to break down 4 things. First, the exact trick dealerships use to make a $49,000 car feel affordable. Second, the mathematical trap called negative equity, and why nearly 1 in 3 Americans is already in it. Third, the surveillance technology lenders deploy the moment you miss a payment, which is genuinely unsettling once you understand it. And fourth, how a $5 billion company collapsed in real time because the same forces at the consumer level also run through institutional finance. And then we're going to end with 3 concrete rules that will protect you no matter what your financial situation is. Let's get into it. When you walk into a dealership, any dealership, they're not going to ask you how much you want to spend on a car. They're going to ask you one question: what can you afford per month? That single question is, arguably, the most important moment in the entire transaction. Because the instant your brain switches from thinking about the total price of a vehicle to thinking about a monthly number, you've already lost most of your negotiating leverage. You've told them the ceiling. And their job, from that moment on, is to fit any car they want to sell you into that number, by stretching the loan long enough. Here's what the data says about how far that stretching has gone. According to Kelley Blue Book and Cox Automotive, the average sticker price of a new vehicle has been above $50,000 for 11 consecutive months as of this year. The average actual transaction price, what people are really paying, sits around $49,300. That is a 30% increase since 2019. The average monthly payment on a new car has hit a record high, $770 per month. And more than 20% of all financed new vehicle purchases, that's 1 in 5 buyers, are now committing to payments of $1,000 or more per month. That figure was 17% just a year ago. It is climbing fast. Now, most households can't actually afford $770 a month on top of rent, groceries, utilities, and everything else that's also gone up. So how does the math work? The loan gets longer. The average new car loan in America is now 69.5 months, almost 6 years. For used cars, it's 67.7 months. But the real number to focus on is among buyers who are already in financial trouble going into a new purchase. 43% of them are now signing 84-month loans. That's 7 years of car payments. 7 years. Think about that for a moment. If you're in your mid-20s and sign an 84-month loan today, you will still be paying for this car when you're in your early 30s, through potentially 2 or 3 job changes, maybe a move, a relationship change, kids. 7 years of your financial life, locked in, for something that is actively losing value every single month while you're making those payments. And that brings us to the most important concept in this entire video: negative equity. You may have heard the phrase, but a lot of people don't actually understand the mechanism. And the mechanism is what makes this so dangerous. Negative equity, also called being underwater or upside down, simply means you owe more on your car loan than your car is currently worth. If your loan balance is $32,000, but the car is only worth $25,000 on the market today, you have $7,000 in negative equity. You can't sell the car without coming out of pocket to cover the gap. You can't trade it in without either paying cash to close the difference or rolling that $7,000 deficit into your next loan, making your next problem bigger than this one. And according to Edmunds' most recent data, Q1 2026, This problem is at near record levels. 30.9% of all trade-ins toward new vehicle purchases carried negative equity in Q1 2026. That is the highest share since Q1 2021. The average amount of negative equity in those trade-ins was $7,183, up 42% compared with 5 years ago. More than 1 in 4 of those underwater buyers, 26%, owed more than $10,000 on top of their next car purchase before they even picked out the vehicle. And nearly 1 in 10, 9.3% Saint, walked in owing more than $15,000 in rolled over debt. To understand why this happens, you need to understand two curves that pull in opposite directions. Curve 1, depreciation. A new car typically loses roughly 20% of its value within the first year of ownership. By year 3, you've often lost 40% to 50% of what you paid. Depreciation is fastest early and slows over time, but it is relentless. Curve 2, amortization. When you take out a loan, your early payments are heavily front-loaded toward interest, not principal. On a 72 or 84-month loan, you are making very slow progress paying down what you actually owe in the first 2 to 3 years. Edmunds' own analysts put it plainly. A lot of these people are not going to get into significant portions of the principal until they are typically halfway into a loan. So you have a car losing value quickly on one curve and a loan balance coming down slowly on the other. Those two curves cross, and the gap between them is negative equity. If you try to sell or trade in the car before those curves cross, you're underwater. And if you're a deep subprime borrower, meaning your credit score is below 580, the numbers get genuinely alarming. Interest rates on used car loans for deep subprime borrowers can reach 21.58% APR. On a $30,000 car with a 6-year loan at that rate, the interest alone can exceed $14,000. The car costs $30,000. You pay $44,000 for it, and it's worth maybe $15,000 by the time you've paid it off. Even for buyers in the underwater category who aren't deep subprime, the numbers are brutal. Their average APR is 7.9% versus the 6.9% market average, and their average monthly payment has hit a record $932 per month. Because when you roll $7,183 in old debt into a new loan, plus finance the new vehicle, you're often borrowing $55,970 total. The average buyer in that position is financing almost $12,000 more than a clean slate buyer. This becomes what financial experts call a debt carousel. You roll negative equity from car to car, and each time you trade in, the hole gets a little deeper. The average age of a trade-in with negative equity has now hit 4.3 years, a record high, meaning people are holding their cars longer than ever trying to outrun the debt and still can't catch up. So what happens when someone in this position can't make the payment? The auto lending industry, particularly the subprime and buy here, pay here segment, has built a remarkably sophisticated technology layer that most borrowers don't know exists until the moment it's used against them. Let's start with the starter interrupt device, sometimes called a kill switch. This is a small electronic component wired between your vehicle's battery and starter motor. Lenders and dealerships, particularly those serving borrowers with lower credit scores, routinely install these devices as a condition of the loan. Some finance companies actively incentivize dealerships to install them by offering additional compensation per vehicle. Here's how it works. If you miss a payment, the lender sends a remote signal. The next time you try to start your car, nothing happens. The engine won't turn over. The car doesn't stop if it's already moving, but once it's parked, it stays parked until the lender remotely re-enables it. Your car has, in effect, been repossessed without anyone physically touching it. These devices are almost always paired with GPS tracking, which means that if you don't voluntarily surrender the vehicle, a recovery agent already has a real-time location. The days of repo men driving neighborhoods for hours looking for a specific car are largely over. But perhaps the most far-reaching technology in this ecosystem is automated license plate recognition, ALPR. Modern repossession trucks are equipped with high-speed cameras that continuously scan license plates as the truck drives through neighborhoods, shopping center parking lots, and streets. These systems can check plates against lender databases in milliseconds. What makes ALPR especially significant is the data network built around it. Private companies like Vigilant Solutions, a Motorola subsidiary, and others have built nationwide databases combining ALPR reads from repossession vehicles, parking facilities, and other sources. This data can be sold or shared across industries. Your car's location may have been passively logged by one of these systems long before you ever missed a payment, simply from driving past a repo truck on the highway or parking in the wrong lot. The scale of repossession this system is processing right now is significant. According to Cox Automotive data cited by Bankrate, car repossessions rose 43% between 2022 and 2024, approximately 3.2 million vehicles. Industry analysts expect the 2025 full-year total to exceed 3 million repossessions, the highest since the Great Recession. In the background, the auto loan serious delinquency rate, borrowers 90 or more behind, hit 5.2% in Q4 2025. The comparable peak during the 2010 financial crisis recovery was 5.3%. We are, in other words, at financial crisis delinquency levels in an economy where the unemployment rate is 4.3%. There is something important to note about who carries this burden disproportionately. Low-income borrowers, households earning under roughly $35,000 a year, carry average auto loan balances that are nearly $4,000 higher than middle-income households, and pay average monthly payments of $738, actually more than the industry-wide average of $680, because they're concentrated in longer-term, higher-rate subprime products. The people most exposed to this technology-assisted repossession infrastructure are also the people who can least afford to lose their transportation. Everything we've talked about so far has been at the individual level: one borrower, one bad loan, one repossession. But the forces driving that individual story are also operating at a much larger scale. And in September 2025, we got a real-time case study of what happens when they break down. First, let's talk about what a car repossession actually costs beyond the vehicle itself. When a lender repossesses and sells your car at auction, the vehicle typically sells for less than its market value. If the auction proceeds don't cover your remaining loan balance, you still owe the difference, what's called a deficiency balance, plus towing fees, storage fees, and administrative costs that can add hundreds or thousands of dollars to the total. Your credit score can drop by 110 to 130 points from a single repossession, and that mark stays on your credit report for 7 years. In a country where 78% of workers commute by car, losing a vehicle doesn't just mean losing transportation, it directly threatens employment. Job loss leads to income loss. Income loss leads to missed credit card payments, missed rent, and in the worst cases, personal bankruptcy. This is not speculation. New York Fed data shows that credit card delinquency rates are approaching levels last seen at the height of the 2008 financial crisis. The Century Foundation and Protect Borrowers reported in May 2026 that the share of Americans behind on a range of household debts, auto loans, credit cards, student loans, simultaneously hit all-time highs in Q1 2026. Total American household debt is tracking toward a historic $19 trillion. These aren't separate trends. They're the same households, running out of road at the same time. Now the $5 billion story. Tricolor Holdings was, until September 2025, the 7th largest independent used car chain in the United States. Based in Dallas, Tricolor specialized in subprime auto loans to buyers without Social Security numbers or formal credit histories, primarily Hispanic immigrant communities in the Southwest. At its peak, the company had a $5 billion loan portfolio, 60-plus dealerships, and more than 1,000 employees. On September 4th, 2025, more than 1,000 of those employees were placed on unpaid leave without notice. 6 days later, Tricolor filed for Chapter 7 bankruptcy, not a restructuring, but a full liquidation. It was one of the largest and most abrupt collapses in the sector in years. The aftermath hit immediately. J.P. Morgan Chase disclosed it expected to take a $170 million loss from its exposure to Tricolor. Fifth Third Bank disclosed $200 million in losses from what it described as alleged fraudulent activity by an unnamed commercial borrower, later confirmed to be Tricolor. J.P. Morgan CEO Jamie Dimon publicly stated, "There clearly was, in my opinion, fraud involved in a bunch of these things." And then he added a line that should give everyone pause. When you see one cockroach, there are probably more. In December 2025, federal prosecutors unsealed an indictment in Manhattan charging Tricolor's founder and CEO Daniel Chu and COO David Goodgame with conspiracy, bank fraud, wire fraud, and running what prosecutors called a financial crimes enterprise. The core scheme, according to the Department of Justice, from at least 2018 through 2025, Tricolor executives repeatedly double-pledged collateral, pledging the same loan portfolios to multiple lenders simultaneously to borrow against the same assets multiple times. They also, according to the indictment, manipulated loan data so that delinquent or charged-off loans appeared current and compliant to lenders. Two other executives, Jerome Kohler and Amron Seibold, had already pleaded guilty and began cooperating with the government. The U.S. Attorney for the Southern District of New York, Jay Clayton, summarized it this way: "Fraud became an integral component of Tricolor's business strategy. The resulting billion-dollar collapse harmed banks, investors, employees, and customers." Here's why this matters to the story of the individual borrower. The same dynamics, overstretched loans, deteriorating collateral values, and a system that profits from selling debt more than it profits from the underlying asset, operate at both levels. The consumer rolling $7,183 in negative equity into their next loan, and the company pledging the same loan portfolio to 4 different banks, are both expressions of the same structural incentive: to create more debt, dress it up, and keep it moving before the math catches up. The difference is scale. So what do you actually do with all of this? 3 rules. These aren't opinions. They're derived from mainstream consumer finance guidance from the CFPB, Edmunds, and financial planning professionals who deal with this every day. Rule 1. Never sign an auto loan longer than 48 months. 4 years is the ceiling. If the only way to make the monthly payment on a vehicle work is to stretch to 60, 72, or 84 months, the vehicle is outside your budget. Full stop. Every month beyond 48 is a month where the depreciation curve and the amortization curve are working against you simultaneously. The car loses value faster than your loan balance falls, and the gap between those two lines is negative equity in progress. Rule 2. Negotiate the total price, never the monthly payment. When a dealer asks what you can afford per month, your answer should be, "I don't negotiate monthly payments. What's the total out-the-door price?" Out the door means all taxes, fees, and dealer add-ons included, the full amount you'd write a check for. That's the number that matters. The monthly payment is a variable that changes based on loan term, interest rate, and how much negative equity from your old car they've quietly folded in. Never let them anchor you to a monthly number. Rule 3. If you're already underwater, do not roll the debt. Rolling negative equity into a new loan is how the carousel never stops. If you genuinely cannot cover the negative equity gap, the better options, in order, are wait and keep making payments until you're closer to break even, make extra principal payments to close the gap faster, or sell the car privately directly rather than trading it in, which almost always yields a higher price than a dealer trade-in valuation. The worst option is the one most dealerships will offer you. Just add the $7,000 to the new loan, stretch it to 84 months, and pretend it didn't happen. And the broader principle underneath all three rules: your car is not an asset. It is the most expensive, depreciating consumer good most households will ever buy. The wealthiest households in America invest in things that go up in value. They drive reliable, boring, paid-off vehicles. The goal is reliable transportation at the lowest total cost, not the nicest vehicle you can technically afford on a stretched loan. If this gave you information you didn't have before, hit the like button. It genuinely helps the algorithm surface this for people who need it. And if you want to understand the next layer of this story, how auto-backed securities are packaging these loans, and what happens if repossession rates keep climbing, subscribe, because that's where we're going next.